The current market consensus holds that artificial intelligence is transitioning software from a passive tool into an active digital laborer. To build this labor force, hyperscalers are deploying capital at a staggering rate. This split-screen diagram highlights the trajectory. On the left, an exponential curve of AI capability. On the right, capital expenditures violently exploding upward. Morgan Stanley projects AI capex will hit $1.12 trillion by 2027. Yet an economic contradiction sits at the center of this boom. AI generates real enterprise utility, writing code, modeling proteins, and optimizing supply chains. But the underlying mechanics funding this point toward a structural market collapse. The market is currently making a critical error. It is conflating civilizational progress with capital security. There is a strict difference between social ROI and capital ROI. A technology can be a profound, permanent leap forward for society and simultaneously act as a wealth-destroying financial bubble for the investors building it. To justify trillions in spending, analysts rely heavily on the new infrastructure thesis. They argue that hyperscalers are simply laying the foundation for the next industrial revolution. You frequently hear comparisons to the 19th century railroad buildouts. Heavy physical labor, steel, and permanent routes carved into the landscape. Railroads did permanently alter human trade, but that narrative ignores the financial reality. The rapid overexpansion of those tracks ruined the majority of early investors. Today, the narrative shifts to power and compute. Markets treat AI data centers like the electrical grid, a permanent rent-yielding moat guaranteeing decades of stable returns. Relying on this traditional infrastructure metaphor blinds investors to the actual economics of silicon. AI hardware does not yield steady rents for a century. It operates under rapidly deflating economics, creating a distinct trap for capital misallocation. The trap is driven by smart deflation. Rapid technological iteration continuously drives down the cost of compute. But as it makes intelligence cheaper, it simultaneously destroys the value of existing assets. Traditional infrastructure depreciates slowly. A railroad-obeyed or data center shell yields returns for up to 100 years. But the core of the AI stack, the accelerator chip, has a severely contracted lifespan of just 4 to 6 years. The most expensive component is quickly dwarfed. When the underlying hardware architecture changes or a more efficient model emerges, the current hardware doesn't simply age. Its pricing power evaporates. AI infrastructure is not a permanent moat. It is a high depreciation trap. Assets lose value faster than they can generate the cash flow required to pay them off. Maintaining the current trajectory of AI development requires a scale of capital commitment that defies normal corporate budgeting. This waterfall chart illustrates Goldman Sachs's baseline projection, $7.6 trillion in capex required by 2031. But a critical flaw is hidden. This requirement is derived entirely from upstream chip sales expectations. The terminal enterprise demand to pay for it remains visibly blank. A healthy tech ecosystem is a demand pull market, where verified enterprise profits mandate hardware expansion. Right now, we have a supply push market, where infrastructure is built based entirely on vendor projections. Deploying trillions of dollars based on the assumption of infinite future demand without verified high-margin end-user revenue is the exact structural architecture of a financial bubble. Proponents of the boom point to the billions in AI-related annual recurring revenue currently reported by cloud providers as proof of demand. This circular flowchart maps out an internal blood transfusion. Hyperscalers invest massive capital into AI startups. Those startups route that exact cash back to purchase cloud compute. The hyperscalers' revenue artificially swells on paper, but no net new capital enters from outside. This ecosystem is heavily sustained by massive, closed-loop investments directed by market-dominant hyperscalers. This circular revenue masks a vulnerability. The industry is struggling to capture sticky, high-margin adoption at the enterprise layer, and without that, the underlying capex build is exceedingly fragile. Out in the broader economy, at the actual enterprise terminal layer, the integration of AI into corporate workflows is stalling due to severe friction. Gartner projects that by the end of 2025, 30% of generative AI projects will be abandoned entirely. The hurdles are poor data quality, complex compliance risks, and an unclear return on investment. This software-level friction is now compounding with physical constraints. AI data centers demand staggering amounts of energy. This line graph projects 945 terawatt-hours of data center power consumption by 2030. Notice the red intersection. Nearly 20% of planned projects face delay risks. High electricity costs and grid wait times don't limit supply. Instead, they act as a heavy leverage amplifier. When enterprise adoption stalls, but physical infrastructure costs and multi-year power contracts are already locked in, the inevitable outcome is massive stranded assets and unpayable debt. To solve the friction at the enterprise layer, the ecosystem is attempting to enforce radical standardization, specifically through frameworks like the Model Context Protocol, or MCP. MCP acts as a universal USB-C port, allowing a central AI model to connect effortlessly to distinct enterprise data silos. But standardization carries a paradox. As it destroys vendor lock-in, watch the digital meter. The price per token rapidly ticks down towards zero. This protocol accelerates smart deflation. By making it easy to swap one model for another, cutting-edge AI is quickly turned into a cheap, interchangeable commodity. As digital intelligence becomes a ubiquitous, plug-and-play resource, hyperscalers permanently lose the ability to charge the monopoly prices required to pay off their trillion-dollar hardware debt. This leaves a final, glaring question. If the economics of smart deflation are this flawed, why are the most profitable companies on Earth still accelerating their spending? The primary driver of current hyperscaler behavior is strategic fear. Missing the next technological era is viewed as an existential threat to their core businesses. It creates a physicalized prisoner's dilemma. Stopping investment guarantees losing the future, but collective, simultaneous overinvestment destroys industry-wide returns. Driven by strategic panic, companies are draining their core operating cash flows and taking on massive new debt simply to ensure they stay in the race. A financial bubble does not require irrational participants. It only requires highly rational players forced by competition into collective, ruinous overcapacity. AI offers a significant, permanent expansion of computing power, but it is currently priced at a substantial premium. The fast depreciating, increasingly commoditized nature of AI utility simply cannot mathematically support current monopoly-style market valuations. As this typographic layout highlights, there is a divergence in the aftermath. After the market correction, society will inherit a powerful, standardized intelligence infrastructure that changes human workflows. But that societal inheritance will come at the direct expense of the investors currently funding it, through capital destruction and severe asset write-downs. Technological revolutions successfully change the world. Financial bubbles dictate who overpays to build it.